Hey folks, and welcome to Credit University, where we talk about what a credit score is, why it's important, and what you can do to build your credit score fast. For today's episode, let's discuss about the basics. So, what exactly is a credit score? Well, a credit score is based on a person's credit history, including the number of open accounts, total amount of debt, history of repayment, and other elements. Credit scores are used by lenders to determine the likelihood that a borrower would make timely loan repayments. Now, the credit worthiness of a client is shown by their credit score, which ranges from 300 to 850. The better a borrower seems to potential lenders, the higher their credit score. Your credit score impacts the interest rate and whether you will be approved for a loan. It's another way for potential employers to determine your reliability. Utility companies and service providers may verify it to see whether a deposit is required. Your financial life might be dramatically impacted by your credit score. It is very important in determining if a lender will provide you credit. For instance, subprime borrowers are often those with credit scores below 640. In order to make up for taking on additional risk, lending institutions frequently charge interest rates for subprime mortgages that are higher than those for normal mortgages. For borrowers with bad credit, they could also demand a cosigner or a shorter payback period. On the other hand, a borrower may qualify for a reduced interest rate and pay less in interest over the course of the loan if they have a credit score of 700 or higher, which is generally regarded as good. Scores over 800 are regarded as exceptional. To put things into perspective, let's give an example. Let's say you wish to take out $200,000 for a fixed-rate, 30-year mortgage. Lenders may charge you 3.3% interest on the loan if your credit score falls into the highest range, 760 to 850. This translates to a monthly payment of $877. But if your credit rating is worse, say between 620 to 639, lenders may charge you 4.8%, which would mean a $1,061 monthly payment. Despite being respectable, having a lower credit score would increase your monthly mortgage payment by $184. You would pay $66,343 more than you would if you had the finest credit during the course of the loan. Consider what you could accomplish with an additional $184 every month. That's all the time we have for today. Tune in to our next episode to learn more about ways to improve your credit score.